Everyone. So today we're going to do lesson 6.5 on home mortgages or home loans. We discussed all of this in class, the reading that you had from the night before, or we read it aloud in class. And so if you did not get the opportunity to have that discussion with us, please make sure that you read through about all the different types of loans that there are out there, credit scores and how those affect your interest rates, which we discussed a little bit when we did lesson 6.2 on car loans, and the life of the loan and how that is going to affect the amount you pay, 15-year versus 30-year fixed. That's mainly what we're going to talk about in this lesson. So in this video, we are only going to do example 1 on Zachary, where Zachary is going to compare loans 1 through 4 before he makes a decision. And we'll use this chart to help us make that decision and compare the 4 loans. In example 2, we are setting everything except for the credit score for Danielle, Rochelle, and Pete. And that credit score is going to affect their interest rate. And then you're going to do that loan amount, monthly payment, and total interest and compare. And then in example 3, same thing, Danielle, Rochelle, and Pete set their credit scores. And we're going to look at the term of the loan being 15 years versus the 30 years we're going to see in example 2 to example 3 and change those and see what that does to the loan amount, monthly payment, and total interest, and make some conclusions based on the numbers we see there. But this video, we are only going to do example 1, because after we get through example 1, I'm confident you can do examples 2 and 3 and analyze further these home loans. So here we got Zachary. He's planning on purchasing his first home. After months of meeting with a real estate agent and filling out paperwork for a loan application, he's finally found the perfect home. The seller has accepted his offer of $213,500, and he's ready to choose what loan he will go with. The bank has given him several options, and they're outlined below. First, notice that loans 1 and 2 are 30-year fixed loans, while loans 3 and 4 are 15-year fixed. So let's notice that first. Let's go with green here. That these term limits are different. Next over here, you've got different interest rates and different percent that is being put down. So when I say 20% is put down, what I'm referring to is a down payment. So while the seller has agreed to accept this offer of $213,500, the bank is saying if you put down 20% of that amount, we will give you this interest rate of 4.7%. Notice in loan 2, if he only puts down 10% of the value, that interest rate is going to be a little higher at 5.2%. Here we see the same thing in our 15-year loans. If 20% is put down, the more that's put down, we get this lower interest rate of 3.8%. Notice that since it's a 15-year and he's putting 20% down, that's the lowest interest rate we see here. In loan 4, it's still 15 years. He's only going to put 3.5% down, and that 3.5% is really important. We see that number a lot when you're looking at an FHA loan. And in our research, we found that FHA loans are the most popular. FHA 30-year loans are the most popular on Americans. So notice here, putting 3.5% down, he still has this interest rate of 4.2%, which is lower than I have in loan 1 and loan 2, probably because I'm still doing a 15-year, even though only 3.5% is being put down. So what the purpose of this is really just to compare and kind of see what would be the best option for Zachary as he moves forward in this process of purchasing this home. So first, I'm just going to do loan 1. So in loan 1, I'm going to cover this up. I might have to look at it again. In loan 1, maybe let's outline over here. I'm looking at a 30-year loan, an interest rate of 4.7%, 20% down payment. So I'm just kind of outlining what's going on. So I'm going to be making monthly payments on this loan. So months, I'm going to start with 0. That's going to be the month I buy it. And how many months am I going to have to go out? So if it's a 30-year loan, I can just do some side work here. If I go 30 years times 12 months, I see 360 total months. So I'm going to be dragging this thing down quite a bit. So I'm going to do my recursive formula here to generate a list that increases by 1 every time. And I've got to go all the way down to 360. I passed it. All right, let's see. Oh, 560. My goodness, I went way far, way too far. How did that happen? I guess because I couldn't see the first number. It dragged faster than I wanted. Might as well show you this now. So here's 360. I don't need anything beyond this, so I can delete this. I'm hitting the delete key, and then I can just drag this blank cell down and get rid of all these extra numbers that I didn't need. All right, scrolling back up. So next what I need, is my balance on the loan. So I'm going to need to formulate my key. So my key over here, I've got the loan amount, which I need to find. My interest rate is going to be 4.7, so I've got 0.047. And my monthly payment, which I don't know what it will be, I'll leave it blank for now. So the amount that Zachary is going to purchase this home for, so I'm going to say home purchased for, it was $213,500. I'm pretty sure. I want to check that real quick. Yeah, $213,500. He is going to put a down payment down of 20% of that. So that's going to be equal to the value, or what he's purchasing the home for, times 0.20. So the down payment, that is a significant down payment, $42,700. It's a lot of money to save. So therefore, the loan amount is going to be equal to what he's purchasing the home for minus his down payment. So this loan amount of $170,800, that's the loan he's taking from the bank. That's the extra that he can't pay for that he has to borrow. So that's going to be the balance after 0 months, and make sure I have this equal to my loan amount, which is in cell G1 for me. Now the payment, I don't know what the payment is. That's what I'm going to be solving for soon. I'm going to start with $1,000. I feel like $1,000 is probably a pretty reasonable payment to pay this thing off. And I'll start with that, and then I'll use Solver once I get this formula typed in and dragged down. So just like a car loan, after month 1, my balance is going to be equal to the previous balance times the interest that's earned. I'm doing a monthly payment, so I got to take that interest rate and divide by 12, minus any payment that Zachary makes that month. When I think about this formula and what I want to roll and what I want to drag, my previous balance, I definitely want to roll because interest is only gained on the previous balance, or the balance the month before. My rate, I do not want that to drag. Whenever I pull it, I want it to pull only from cell G2. In my payment, I don't want it to drag. If I drag it, it would roll down into zeros. So I need to fix the payment as well. So you can see here that if he makes a $1,000 payment after this 1 month, my balance does go down a little more than $300. So now what I want to do, let's drag this down. Let's see if $1,000 will do it. All right. And it looks like it. Yep, I get a negative number, so it looks like it's getting paid off somewhere up here. Looks like it's getting paid off in month 283. So he's going to have to pay less than $1,000. Good news for Zachary when he's doing this analysis. I'm going to go ahead and freeze the panes so I can see more of what's going on. I'm going to make this a little smaller just so I can see a little more. So this way I can see this bottom number when I'm going to use Solver. All right. So now I'm going to use Solver to solve for this monthly payment. I'm going to make these more distinguished since it's my key. All right, so in Solver, this is my objective. I want this cell B362 to be a value of 0. So let's go to Data, Solver. And there it is, since I was already in there. It puts it in for me to be a value of 0. Oh no. I am experiencing what you guys do so often. Let's see. My cursor is there. Okay. Oh my goodness, this happens to you guys all the time. Now I understand how frustrating it is. my cursor is going away. I just hit escape. I'm going to save this so that I don't lose it all. I'm going to save this as lesson 6.5 in case I have to reopen it. Desktop. All right, let's try it one more time. Solver. My objective is here. I want it to be a my value of is not working. Not good stuff. Okay. So I'll escape, get out of there. Make sure this is saved. I'm going to close it down. I'm going to quit Excel. And then get rid of all this stuff and let's see. Lesson 6.5 is here. Let's wait for this to open up. Sorry about this, guys. Hopefully you can just fast forward. All right, so let's give this a go one more time. I'm here, data, solver, value of 0 by changing the payment. And there we go, it's gonna work this time. Hit solve, and there it is. It looks like the payment's gonna be $885.83, and that thing is gonna be paid off. So now what I want to do is I want to consider some of the other questions that they have here about total dollars paid and total interest paid. So when I'm looking at total dollars paid, I'm going to be able to calculate this by taking my payment and multiplying it by 360 because he makes this payment 360 times. So I can see that over the life of the loan, he pays $318,900.02. Now, the total interest is going to be equal to the total dollars that Zachary pays minus the loan that he took out. So there I can see the interest is pretty substantial. It is little under $150,000 in interest on this home loan over the life of 30 years. I can also look at the interest and generate an interest column like I did with credit cards here. So there's no interest that is earned in this first or the 0th month. And then in the first month, you got to go to the previous balance, which is going to be right here. And just multiply that by the interest rate divided by 12. And think about in advance, if I'm going to drag this down, you want the previous balance to drag, but you don't want the rate to drag. So we're going to fix that. So you can see in this first month, think about this. This is pretty eye-opening. Let's roll this down a few. In these first few months, he's making a payment of $885.83. Of that, these are the total dollars each month that are going towards interest. So the total towards the loan, like his principal is what it's sometimes called, principal on the loan, is equal to the payment that he's making minus the interest. And so if I want to drag this down, think about it, the payment's not changing at all. So I want to take the payment minus the interest each month, and you can see how much is actually going towards paying off the loan. And that really does break your heart when you're actually thinking about making this payment and more than half of it just going to the bank, straight into the bank's pocket. You can drag this down to 360. You can drag both of them down. And what you'll notice is there's a shift. So let's go to like 180 because that's about half. That's half of the loan. You can see how these numbers get really close together at about the 15-year mark. And so the interest paid and the total dollars going towards the principal of the loan, they're really close to one another when half the loan is paid off. Before that, most of the money is going to the bank. And then they get equal. And then as you get closer to paying off the loan, now most of the money is paying off your loan and less of the money is going to the bank. This design is very intentional so that early on, when you're making these payments, the bank is going to get their money early on and you will be the benefactor of this setup later on. I can also add up this interest column, and I should see the same interest that I see when I did the total dollars paid minus the loan. So I'm going to have to drag this all the way down since I'm using a sum formula. I should see about $148,000, $148,100. Let's see how close I get. Look at that. It's the same. $148,100. Same thing I have here. So we're not going to have to generate all 4 of these columns every single time. I really just wanted to show you how this interest column and the total towards the loan looks. And notice too, if I were to add up these two, I should always have this equal to my payment. I'm not going to do all the way through, but you can see how it always equals your payment when I add those two up. All right, so this is the first loan. Let's see, let's rename this. This is Zachary, loan 1. Let's do a sheet and let's just name it summary. And let's model it based off of this table right here. So I want to have loan 1, loan 2, loan 3, loan 4. Then I have the monthly payment. I have, what else is in this chart? Total dollars paid. And total interest. Let's go ahead and wrap the text here. And yeah, that should be good. So what I can do is I can show you how you can actually pull from across sheets. So I can say monthly payment for loan 1 equals, I can go to loan 1 and grab that monthly payment and just hit enter and it'll pull that number. Total dollars paid is equal to, let's go to Zachary loan 1. Total dollars paid I believe is here. Why on earth is that doing that? Okay, it's gone now. Equals, and it's gone again. It's insanity. I do not want that. So it is F6. Let's try this. Let's try the interest equals total interest. So that works. It's just because it's popping up. Let's do this. Equals, copy this. Let's put it in here. Make it F6. I don't want that there. I want it here. Now, there we go. So now those numbers look good. So you can always pull from the sheets, although it's a lot less complicated if the equals Zachary L1 doesn't show up exactly right over the one that you're trying to pull from. All right, so now I need to do Zachary loan 2. So Zachary loan 2 is also a 30-year fixed, and the only difference here is the interest rate, and he's only going to put 10% down. Since I already have a 30-year loan sheet built, I'm just going to copy this right over. And I'm going to rename this Zachary loan 2. I'll adjust that rate to 5.2%, so 0.052. And he's only putting 10% down. For this down payment, instead of multiplying by 0.2, I'm going to multiply by 0.1. And notice that changes the loan amount. It's higher because they only put 10% down. And I need to change this loan now to $192,150. All right, so now you'll see here that is no longer zero. This $885 is not going to cut it. I'm going to have to pay more. So I'm going to have to use solver. And it looks like all of these are going to be the same. So I'm just going to be able to hit solve. And notice that payment goes up. And since I already had the sheet built based on this 30-year loan, my total dollars paid changed, my total interest changed. Notice it's more. You can see here these numbers changed in the interest column. The amount towards the loan changed. So all of that is good. Now what I want to do is I want to pull these things into my summary sheet. So for loan 2, it's going to be equal to that payment. Notice that it's more. Total dollars paid is going to be equal to right here. And total interest is going to be equal to right here. So you can see just by comparing these two loans from loan 1 and loan 2, and these again are my 30-year loans, so maybe what I'll do is I'll shade those this yellow and I'll shade these two the green since I know they're different lives of loan. You can see that by the only change here, putting down 20% in loan 1 versus 10% in loan 2, which changed the interest rate, your monthly payment is more. And if you wanted to calculate how much more, you could just come over here and say payment minus payment. You can see it's $169 more. You can see total dollars paid is a good chunk more. We could calculate those differences just if you're interested by subtracting these two numbers. You're going to pay almost $61,000 more. And of that, little less than $40,000 is going to be in interest that you're going to pay more with loan 2 if you can't come up with that 20% to put down. All right, so I'll get rid of those. By means of comparison, loan 1 is looking awesome. Loan 2, not so much, but or not as good as loan 1, but think about the down payment. $42,700 is a lot to come up with. Maybe Zachary can only come up with $21,000 to put down on his loan. I would say the down payment is the hardest thing when you're trying to buy a house to come up with, because in the meantime, you're still paying rent if you don't own a house. It's really hard to come up with these large sums of money to save to put down on a house. That's why that FHA loan is so popular. All right, let's look at the next one, loan 3, the 15-year fixed with an interest rate of 3.8% and 20% down. So I am going to go ahead and be able to copy this sheet, but I'm going to have to make some pretty significant changes to it because this one is only going to be a 15-year. So if it's only going to be a 15-year loan, I no longer need to multiply 30 times 12. I need to do 15 times 12, or just take half, and I see I only need 180 months. So I'm going to scroll this to the 180 mark. I'm going to delete this, and then I'm just going to delete all of these. And then I'm going to, I guess I don't even need that. I'm just going to grab everything I don't need. I'm just going to delete the whole rows. You could have dragged down the empty cells if you wanted to. I'll just hit delete, and they're all gone. Cool. Okay, so that's good. Let's change this information. So my interest rate here is 3.8%. And I am putting 20% down, so this is kind of nice. So here I'll put 20% down. I do need to change this back to my 0.2. And therefore my loan is going to be $170,800. While I'm thinking about it here, I need to go to the Zachary loan too, and I want to change this. My interest rate was 5.2. I forgot that I kind of put these notes in here for myself. And this goes to a 10% down payment. I just want to make sure my notes match the loan here. So change that in loan 2. Now I'm in Zachary loan 3. I've changed this information. Now my rate needs to change to 0.038. All right, so all of this is looking good. The loan looks good. This looks good. The payment is not enough, not even close. So let's go ahead and use Solver. And that's good, but this is no longer my objective. My objective is in B182. I can't see it here, but if you want to scroll up, you can see There it is. That's my objective. If you didn't type that in or know what it was, you can just go click it. There it is. Let's solve for that payment. And you can see that it goes up to $1,246.33. Now my total dollars paid formula is also going to be off because I multiplied that payment times 360, but I'm only making that payment 180 times. So I need to multiply by 180. And you can see that number goes significantly down. And you can see that interest there is now going to be good with the total dollars paid minus the loan. All right, so let's take a look at those in comparison. Let's go to the summary. So for loan 3, monthly payment is going to be right here. Total dollars paid, let's go grab that. It's here. And for total interest, let's go grab that off my loan 3 sheet. So there it is. So you can see while the payment is going to go up because you're making payments for only 15 years, you're going to have to pay more. It's really not that much more, especially when you consider the total dollars paid. You are paying over $100,000 less than loan 2, close to $100,000 less than loan 1. And that interest, I mean, you just look at that number. It is so much smaller than the interest in loan 1 or loan 2. Again, for this loan, you're putting 20% down, so you're still having to come up with the same down payment as loan 1, but it is a huge difference in the total interest paid column. All right, so let's look at loan 4. It's a 15-year still. My interest rate is lower than any of the 30-year loans, but I'm only putting 3.5% down. So let's see what that is going to do. So I'm going to make a copy of my 15-year, and then this should only require pretty minimal changes. Let's change this to Zachary, loan 4. 15-year interest rate was going to be 4.2, and down payment is only 3.5%. I want to check that 4.2 number real quick. Yeah. All right, so my rate, 0.042. Now my down payment, instead of multiplying by 0.2 for 20%, I got to multiply by 0.035. So look at that down payment. The down payment is under $8,000. You can see why those FHA loans are so popular because that down payment is super manageable. But the loan amount increases significantly. We're going to have to borrow $206,027.50 this time. So you can see that payment is not going to cut it. Let's use Solver to solve for the new payment. All right, so you can see how much that payment goes up since I had to borrow a significant amount more. However, take a look at the total dollars paid and the total interest. Your interest, you notice, I mean, it's more than the last one because you had to borrow more, but it still is significantly less than the 30-year loans. Let's go to the summary sheet so we can see it all together in one spot. So for loan 4, monthly payment is a good bit more than any of the others, but the total dollars paid here, it's going to be more than loan 3, but it's still less than either of the 30 years, and my interest is a little over $72,000. So there's a few things that I want to notice here, and that's that the 15-year loan, even if you're going to put less down with that FHA, you're still coming out more of a winner doing a 15-year loan than you are in the 30-year loan because you are paying significantly less interest over time. But in order to do that, you are going to have to make more sacrifices on a month-to-month basis, and you're going to have to pay more month-to-month. But think about this. With all the money that you're putting towards this home loan, think about the fact that you're paying this mortgage off 15 years sooner than you're paying these off. So not only will you pay this off after 15 years, you're going to have 15 years where you're not making any home payment, whereas you would here in loans 1 and 2. And think about all the interest that you're going to save when you're looking at these numbers. These numbers, it's just staggering how much money. And this house is probably, I mean, it's a pretty average house probably, $213,500. I mean, that's a good house, but when you're looking at the Charleston area where we're from, I would say it's not going to get you much. Um, so think about how these numbers are going to be that much higher when you're borrowing even more money. So that's the video that we're going to do. I'm not, like I said, I'm not going to go through example 2 and example 3 because I think you have the tools now to go through and do these on your own and analyze on your own. So that is home loans lesson 6.5.